Dave Ramsey recently told the world that about 78% of people do not have the discipline to handle a credit card. His argument was simple. Most people will carry a balance, pay high interest, and eventually get themselves into trouble. He also says a credit score is basically a measurement of how much you love debt. Now listen, I understand where the message comes from. I fund deals every single week, and I see people bury themselves in bad credit decisions all the time. But here's the part of the conversation that almost never gets explained. In 2026, completely opting out of the credit system can quietly cost you thousands, hundreds of thousands, or millions of dollars every single year. Not because you're irresponsible, but because the financial system now runs on trust scores, and you need to leverage them in order to get ahead. When lenders, insurers, and even utility companies cannot measure risk through your credit profile, they price you like the worst possible borrower. So today, I want to show you something that most people never hear about. Why the zero credit lifestyle actually acts like a hidden tax on your family, and how smart entrepreneurs build leverage the right way without falling into the traps I see every single week when my team reviews underwriting files. The real cost of being invisible. When someone follows the advice to have no credit score, what they're really doing is becoming invisible to the financial system. And in underwriting, invisible is treated almost the same as high risk. When my team reviews files, the system does not say this person avoided debt responsibly. The system simply says we have no data to give you. And when lenders have no data, they're going to assume the worst. That's what I like to call the ghost tax. Your credit score today functions like a trust score across almost every financial product that you use. That includes insurance pricing, mortgage approvals, auto financing, even utility deposits are all influenced by it. If those three digits do not exist, companies price you like someone who might default tomorrow, especially if you're a small business with less than 500 employees. The numbers behind this are shocking. Homeowners with no credit history often pay around $2,000 more per year for home insurance than somebody with strong credit. Same house, same neighborhood, same coverage. The difference is purely risk modeling from an underwriting perspective. I've seen the same concepts apply with auto insurance files. Drivers with no credit history can be charged 3 times more for the same exact policy. And when it comes to utilities, I constantly see deposits of $300 to $500 required just to turn the lights on. So from a lender's perspective, it does make sense. If they cannot measure risk, they protect themselves with pricing. But from a household perspective, that invisible tax slowly drains thousands of dollars from your finances every single year. That's money that could have been building wealth instead. The manual underwriting nightmare. The usual response people hear is just use manual underwriting. And in theory, that sounds simple. In reality, I see these files all the time, and it is rarely simple. Manual underwriting is a paperwork marathon. When somebody has a credit score, an automated underwriting system can approve a mortgage in minutes. But when there's no credit score, the entire file has to be reviewed by a human underwriter. I have friends in the mortgage, residential, owner-occupied mortgage loan business that have nightmares about manual underwriting process. Now suddenly, you find yourself as a borrower gathering 2 years of payment records, rent checks, utility payments, phone bills, insurance history, and the list goes on. I have personally seen deals fall through because one document from 2 years ago could not be verified. Now, if that person had just had a credit history, that verification would have just been on their report. The other issue is qualification rules. Borrowers with credit scores might be approved with debt ratios up to 43 or even 50%. Manual underwriting often cuts that closer to 36%. Same income, same job, same financial habits, but the borrower with no credit score qualifies for a much smaller mortgage. down payments for them also increase. Buyers with strong credit might enter the market with 3% down, while manual underwriting borrowers often need 10 to 20% down on their home. And while they're trying to save that larger down payment, housing prices keep rising. That is an opportunity cost that most people never calculate at all. Waiting and getting all of your documents together for a manual underwriting process since you didn't want to have a credit score can literally price you out of the market. Wealth building versus wealth shielding. This is where the conversation usually gets misunderstood. Most traditional financial advice focuses entirely on avoiding debt, and avoiding bad debt is absolutely smart. But what I see in real business funding is something very different. Successful entrepreneurs, the millionaires, the 8-figure millionaires, the 100 millionaires, the billionaires, they all use leverage strategically. They do not use credit to finance lifestyles. They use credit to finance growth. They use other people's money as leverage to invest into something that's going to make them more money. Lines of credit, equipment financing, invoice factoring, and revenue-based financing are tools used every day in real businesses as leverage. In fact, about 90% of business owners will touch some form of alternative financing at some point. The key is understanding how to use it responsibly. Where I see businesses get into trouble is stacking the wrong debt. They take one short-term position, then another, without a plan to graduate into better capital. Before you know it, they're taking money from Peter to pay Paul. That is when cash flow gets crushed. But when capital is used correctly, alternative financing can act like a bridge to conventional financing. It helps businesses that are shorter in their time in business or lacking net profitability grow until they qualify for cheaper options like bank lines of credit or SBA programs. Now that latter matters because responsible leverage is what allows businesses to scale faster than waiting for their own cash alone. The hero's journey to capital. This is the framework I talk about constantly with clients. The funding ladder. Every business starts somewhere. Sometimes that first step is alternative capital, revenue-based financing, a small line of credit, or equipment financing to acquire assets. Used correctly, these tools create huge momentum. Momentum increases revenue. Revenue improves underwriting metrics, and you have a higher cash flow balance as your revenue gets higher from this momentum. Eventually, that business becomes eligible for bank capital or SBA financing. That progression is what separates struggling businesses from scalable ones. I've seen companies move from small revenue cash advances to 6-figure or 7-figure SBA loans simply because they followed that path correctly. But I have also seen businesses destroy their fundability by stacking short-term capital and cash advances with no plan. That is why responsible capital strategy matters so much, and people need to hear this. When done correctly, business credit becomes separate from personal risk. Your business builds its own trust profile. That trust unlocks much larger funding opportunities over time to building a real company that actually has the resources it needs and scales. The reality is the financial system is not going to change. Credit scoring is not going away, and underwriting models are not disappearing. The only question is whether you understand how to work within the system strategically and make it work for you, not against you. Waiting has consequences. Using capital incorrectly also has consequences. And stacking short-term financing without a plan can destroy your fundability for years. So if you want to understand where you actually stand right now, my team can help. Below this video, you can schedule a quick funding strategy session with us. During that call, we're going to run a real underwriting review of your exact situation. We'll show you what you qualify for today, determine whether SBA financing or alternative financing is the best and most realistic option for you, and map out your funding ladder so you understand the next steps to reach better capital. This is a real evaluation of your fundability. If you're serious about building your business the right way, why? Click the link below and schedule your brief review. We'll walk you through your numbers and help you understand the smartest path forward. I'll see you there.